Hi everyone, welcome to my YouTube channel. My name is Tabitha and today we're going to talk about why we should learn financial literacy. So we are back again with chapter 2 of Read Dad, Poor Dad. And all the information that we are going to talk about is going to come from that book. It's a book that is popular and a lot of people read it when you are starting with your personal finance journey. So it's just the first grade 1 book for the finances. So I would love to give my own interpretation about what is the information in that chapter 2, which mostly talk about a lot of stuff. So let's go in and see how we should. So why should we teach financial literacy is the question, because like if you understand how your money works, and then you will have a easier life, or maybe life would be manageable. So let's see, why do we have to learn financial literacy? What's the difference between those who have financial literacy versus those who do not have financial literacy? So why teach financial literacy? It's because it's not always how much money you make, but how much money you keep and for how many generations. So this is the reason why we want to have financial literacy. A lot of people who don't have financial literacy do not have money because they don't know how the money works or how they should manage their money. So let me explain this quote with financial literacy, financial statements. Like, let's say, for example, you have income, you have a job, you have an income that is coming in. So what you will do is instead of doing budgeting, you can do allocation, where you take part of your money and invest them in asset section of the balance sheet. And then from there, now the money will grow and grow and grow, and if it's enough to sustain you can take part of it to the next generation. And that's what we were talking about, keeping it for the next generation, how much money you make. So when you say keep your money, doesn't mean like you should not buy your food, you should not buy your clothes or what. No, it's not like that. So it's like, do you have priorities? Have you allocate your money? Because if you do allocation, it means like every sector will be taken care of. It doesn't matter how different the percentage are. So whatever that is your priority will take the higher percentage of your income. So let's see how we will be doing this. So if you're new to this channel, please subscribe for more videos. I would love to see new subscribers, and we should grow together and learn together. So the agendas of today, like we have said before, is like, why do we strive to have financial intelligence? Why do you want to improve your financial intelligence? And a difference between assets and liability. Sometimes we don't know the difference, and that really get us into trouble when it comes to how we manage our finances. So for example, do you know how the cash flow patterns of an asset? Is that what you have, or do you have a cash flow pattern of a liability? Are you one of those who is just like working to pay off credit cards or loans or mortgages or those stuff? Do you have something that is coming from the asset section? And cash flow pattern of the poor people, majority of us, right, will fall into this category. So do you still want to be in that cash flow pattern of the poor people, regardless of how much money you make? So, or will you choose to have a cash flow patterns of the rich people? Yeah, you don't have to be rich to have the cash flow pattern. You can start right now and keep practicing until you get to have it, like this Roberts, or maybe those of Donald Trump. So they have that cash flow pattern of the rich people. And then again, how do you avoid the rat race? So mostly this is the most common word used. How do you get yourself into a rat race? We will also look at that. and whether a home as a liability or a great asset. It just depends on individual. Like most of the time, we're not saying like you do not buy your house, but do you really bear the liabilities that come with it? Are you prepared for them? Because those who are not prepared for the liabilities that come with the house, most of the time they end up losing their house. So we don't want you to be one of them. So let's see. It's like I've said before, we are dealing with Rich Dad, Poor Dad, chapter 1, which is why do we teach financial literacy? Why? What makes you different if you have financial literacy? So are you different from that person who inherits a lot of money and they never use it? They end up like being poor again, or those lottery winners that become rich and suddenly goes back to being poor. So are you different from them? So, and why are you? One reason why majority of people will want to have financial literacy because they want to keep more of their money and let that money grow for them and be their wealth. Like if you pay a lot of expenses, like you're billing someone else, you're billing different companies based on whatever you're interested in that you buy every day. So do you want to keep, if you have financial literacy, if you have financial intelligence, you will see that this is not necessary and this is more necessary and this is more important and this is not more important. And with that, you will keep more of your money. And if you keep more of your money, you can have something that you can invest in asset, and that one will grow over time, and you can leave that money to your family if, just in case if you die later in life. So you can retire early. Like those who have financial literacy, sometimes they do not have to work until 67 years. They can decide to retire early if they can afford to that lifestyle that they're living right now. So most of the time it's not like retirement is not age, but the amount of money that you have to sustain your current lifestyle. Let's say I was a doctor and then I have saved enough money that can cover my salary as a doctor, and then also like any other expenses or other expenses that I was taking care of. But for how many years? So like if I'm a doctor, I earn this a lot of money, and then I want to retire. I want to really calculate how much money do I have in my bank account that will sustain that lifestyle of being a doctor and out of work for how many years. So if I'm left with 20 years, so and then I can see if that money is going to really retire me. So retirement is not about age, but about the money that you have. You can retire anytime at 20 years, 25 years, 40 years, regardless, like depending on whatever you decide. Grow your wealth automatically and stay ahead of inflation. Those who have financial intelligence, they do not keep most of their money in the bank because they know in the bank the money is not growing. And because of that, they lose money through inflation. So if your money is not growing, you are losing it to inflation. The value of your money today is not the same as the one that, like, it's not the same value like tomorrow. So it will be less value tomorrow. So those who have financial intelligence will put their money where it can grow. So the difference between assets and liabilities, and why rich people buy assets instead of liabilities. So this is why what really not knowing the difference between asset and liabilities is the reason why we have a gap in our society where there are a lot of people, there are few people who have money, and there are too many people who do not have money because we don't know how assets and liabilities differs. So So in this case, an asset based on the Rio Robert, using the Robert example, they have say like the asset is the one that put money into your pocket. So something that bring you money is the asset. What about like the liability? So according to Robert, liability is the one that take money out of your pocket. Let's say, for example, like you have a credit card, and then that credit card you use $1,000 from it, and you do not pay it back on time. If you do not pay it back on time, the company will charge you interest. What does that mean? Is like that credit card has taken that interest in form of money out of your pocket. What about here on the asset section? So if you have your income, your asset, your money, the money that you invest into real estate, so that real estate will give you back money, and in terms of cash flow, if you rent it out to someone and then they rent it, you pay your mortgage, the leftovers become your asset that build your portfolio. And for this credit card, we keep taking out money from your pocket. So how does this one work? So this one has to go with the income statement and balance sheet. So here, let's see, like you earn your money, right? And then you do allocation. So when you allocate some money to asset section, which means you're buying assets that give you back money, right? But if you do not use allocation method and you use budgeting methods. So in the budgeting method, inside income statement, so what will happen is, like with budgeting method, you pay your expenses first. And then if you're that kind of person who have higher expenses than your income, and then you have nothing to save that month, you're not investing in anything, but you will end up buying liabilities, like signing up for credit cards so you can keep up with your expenses. So that what make that difference. So it's very simple. Assets put money in the pocket, liabilities take. So asset cash flow pattern is and then we also have liability cash flow pattern. So for asset, we have income statement, an income statement for both. So let's see, here you have income and then expenses. That is for the asset cash flow pattern. And then for liability cash flow pattern, you have income, then expenses. Most people who always have a liability cash flow pattern are those who have income that are exactly equal to their expenses, or sometimes expenses are even more than the income. So they had like borrowing money that is not theirs, and then they keep on paying that one back. So this kind of liability cash flow pattern, you don't have no money to invest in asset. Yeah, but you can fix it if you're on this side. So which means you can make sure like your expenses are lower than the income, and then the income now you can have leftovers that you can put to asset section, or you use allocation method of managing your money. So the balance sheet, and then we have balance sheet here. So on this side, we have asset and liabilities. On the side, assets and liabilities. So the cash flow pattern is this way. So what happened is you receive your income, and then you allocate some money to your asset section, and then this asset section will grow and grow and then give you back more income. Get it? So with this kind of cash flow, most of the time you do not come to liabilities section because you don't need people credit card. You already have enough money coming out of your asset section. and your salary or job. Yes. So that's the other part. And then on this side, we have the liability cash flow pertinent. So here, the income you get is most likely equal to the expenses because you buy too many things. You buy too many things. So when you're buying too many things and then you're using the budgeting method of managing your money, and then you end up not having anything because you have to use all your money to pay expenses. And then because you have too many expenses, you end up buying liabilities, getting the liabilities to help you pay expenses. So every income is just going out. It's just going out. There's nothing that you're saving here. There's nothing that you're investing on this side. So on this side, they're using budgeting method of managing your money. On this side, we're using allocation method of budgeting money. So allocation methods of managing money. So assets come first. The money that for asset come first. You pay yourself first, and then you can pay your expenses as long as you manage your expenses to be lower. Cash flow pattern for poor people. So what happened with this thing is of a poor person and a cash flow pattern for a rich person. Let me put myself somewhere here. Corner. So yeah, here we have those two. So what I said in the previous slide is that the people who have liabilities, cash flow patterns, they tend to use budgeting methods, and those are mostly the poor group, like where all of us fit in. So we always have salary or wages, and then we have expenses like taxes, rent, and food, and then people are rich, the rich people, they have most of the time they do not work for anyone, so they have businesses that pay them, that make them money. So their incomes will look like they have rental income, they have dividend income, they have interest, they have royalties, and they also have expenses like taxes and mortgages. So what really makes the difference is the balance sheet here. So on the balance sheet of the person who is poor, maybe if they're lucky enough, they bought a house. So and then they have mortgages, they have car loan, they have credit card debt, they have student loan. So this is where majority of us fall into. And this kind of person who is a poor person do not have any assets. They do not have no asset. They are all swamped in with their expenses and liabilities. So if the money is not enough to pay expenses, they come in here to borrow other people money. And then when they borrow, the borrowing money comes with, the borrowed money come with the expenses, like cost of borrowing. So there. So here we will come in and then talk about, let's talk about rich people balance sheet. They are rich. So when people, cash flow patterns of a rich person will be, they have assets. This one do have assets. So this asset become also income on the other side. That's why they do not work for people. So real estate, they have real estate, they have stocks, they have bonds, they have notes. So these assets. So assets, they keep growing, and then some of them become income that they use to pay expenses. Them too, they have liabilities, but the good news with them, because they are financially informed and they have more knowledge about finance, so they will keep reducing their liability section. they keep reducing their liability section, they keep reducing their expenses section, and then they concentrate more on the asset section because they know the asset section will be bringing in money. They don't want liabilities that will be taking out money. So they want something that will be putting in more money, putting in more work. So they look at this like they are their employees. This is their work. This is avoiding the rat race trap. So a lot of people are trapped in the rat race. But what it is rat race in the first place? So what happened is when you have a job and then you want like how you choose to spend your money matters, right? This is what will really will help you not to get into a rat race when you're aware, like where is your money coming from and where is your money going? And then you're more aware of your finances and you know what is next and what is next and what is next. So here, so someone has a salary and they want to get a salary increase. When they work hard enough to get that increase, so their income increase and they're happy. They take their spouses to dinner, they take their whole community to do parties, they sponsor parties, they do all these things and that and that and that, right? So what happened is that like after the income increase, the expenses too increase because now there's more money to buy more things according to them. So, and these are individuals who do not have financial literacy. So they do not have financial literacy. So they think like once we increase our income, we are spending. So the spending goes up, the expenses shoot up. So when that happens, the balance sheet suffered. So instead of them paying off some of their liabilities, because the expenses goes up, their liabilities will also goes up so they can keep up with the expenses. So this individual do not have no assets and they are caught up in what we call rat race. So income increase, expenses increase, liability increase. So they make more money to pay for the expenses. If the expenses is not enough, and then they come back and borrow money from other financial institution, and then they pay the expenses, and then the cycles continues. So they just live life going around paying, and there's nothing that they are growing for themselves. They're not growing anything to invest in real estate. They're not growing anything to invest in stocks. They're not having any money left to buy royalties. They have nothing. So they have nothing in their asset section. So asset column is not their focus. Their focus is on expenses and liabilities. And that's what really keep them running. Keep them running. They pay this, they borrow, they goes back again, they do the same thing. They do that today and then they do that tomorrow to Tuesday, like that. So they just keep running in cycle. That is what we call rat race. For you to avoid rat race, you have to choose properly how you will manage your money. Look at your priorities. Do not pay attention to what everyone is doing, then you will end up being in a rat race because you will try to copy everybody and then people's expenses are different. So if you avoid that, once your income increase, you do not need to go increase your expenses. Instead, the money that has increased, the money that is more on top of your regular income should now go into your asset column instead. And this asset will grow. And then when this asset grow, it will goes back as income and you can use it to pay more of your expenses. Now you can maybe add a bike. You can buy a bike, or maybe you can go ahead and buy a birthday gift to your mom, or maybe buy a birthday gift to your sister because you have more income coming out of your asset. But if that's not the case, you go into the rat race. Home as a liability. So this point is not to tell anyone that you should not buy a house, but you should really understand the liabilities that come with the house. That's what this statement need to say. According to Robert, he said that home is a liability, it's not investment, unless if you buy a home that you will use for business purposes. But here, if you're buying a home as a residential area, and then it is not asset, it's a liability. So here we will look at how the read that put it. So so home as liability, when you look at the read that put it as a liability, and the poor dad put it as assets. So the rich dad understand the liabilities that comes with a house. So he doesn't look at it as an asset as long as it's the primary residential house. So it is not guaranteed that it is an investment. It is more of a liability. So it comes with property tax, come with like maintaining costs. It's come with it comes a lot of things, insurance. So all those things, if you put them, you are just looking at expenses, and all these expenses can be a liability to your income. So let's say, for example, you have this house, you got this house, and you lose your job. So will it be an investment? No, you will need to pay all the mortgages, all the property tax, you have to pay insurance, you have to pay that one. So as you go out and buy a house, you need to understand that there are liabilities that come with it, and let's finger crossed that you do not lose your job. So if you lose your job, that's when the reality now kick in that it is not an asset, but it's a liability. So on the poor section, the poor dad section, he put it as an asset because they believe like it will increase, the value will increase in the future. Yes, sometime, but sometime it doesn't really work like that. It depends with the market, depend with the situation and why you were selling your house. So there are a lot of reasons why house is a liability according to the rate dad. So this house come in with a 30-year mortgage. So which means you have to pay that. Yes, if you have to pay that, it means like it's a liability. You're not receiving income from this house, so it's a liability. Asset is something that put money into your pocket, but a liability is something that take out money from your pocket. So a 30 years mortgage is taking out money from your pocket. And although there are tax deductions that come with the house, most of the expenses are paid using your after-tax money. So which means they are part of your expenses. So it's a liability, not an asset, because it's taking money out of your pocket. So that's the concept, right? So, and then here, where property tax on your house can increase. So, especially for those who are retiring, right? Your property tax will increase because property tax will increase because some of them, they're just going to die soon. So why don't we just tax them higher? House value. So like I said before, house can appreciate or it can depreciate. It depends with the market. Let's say, for example, this year, like this first 2 years because of coronavirus, so a lot of people goes into foreclosure. Like those who do not have like emergency fund to keep on paying their expenses that come with the house. they end up like foreclosing. So if you foreclose your house and maybe the market is not favorable, so if the market is not favorable, is you have a lower chances of selling your house with a higher price than what you bought it for. So a lot of people end up like selling their house lower price. So we mean they went on a loss. The market, the house did not appreciate in value. You have missed opportunities. This one mean that like if you lock your money into your house, which is primary resident, which is also a liability, and then you miss opportunities of maybe investing in stocks, buying notes, buying stock that pay you dividend, all those stuff, like things that you will miss out because all your money is tied up into your house, your primary residence, which of course is also a liability. This the whole video is more of, if you want to be rich, you need to be financial literate. So start learning by yourself, start reading books, start experiencing with people who have already achieved this kind of financial independence, because like you can work, spend all your time working, but if you do not know how to manage your money, you will keep working for life. And pay yourself first is part of this video before. Like once you receive your income, you have to allocate your money, which means the money that goes into investment, the money that goes into stocks or dividend or maybe real estate or stuff like that, thing that will give you back money. So should be the first priority. So take that money, put it into the asset section, and then let that asset grows to give you back more income. So buy luxury last. Do not just buy things because so and so had bought it, because that one would put you into a situation of financial struggle. Like you have to keep up paying this, even thing that you could not afford. Reduce expenses and liabilities. So anyone who really want to get ahead in life in terms of finance, they need to reduce their expenses and liabilities. Aim for more valuable assets. You buy valuable assets. So maybe you can start with stocks, and then it's giving you maybe $10 a month, or it's giving you $20 a month. Later on, once you are growing that asset column and it has grown big, you can have maybe go buy gold, you can go buy diamond, you can buy royalties, all those stuff. So with time, you get wealthy and wealthy and wealthy, as long as you know the concept that get your income, allocate your money, put some put some into your asset section, pay your expenses, maintain your expenses. Do not increase your expenses once you're getting more income, and then avoid liabilities. So if you cannot avoid them, and then manage those liabilities, manage them, pay them a little bit by bit until you get to pay them off. And that's the end of the video. If you're new to this channel, please subscribe for more videos and hit the notification bell for more videos. Thank you, and I will see you next time.